Welcome back to another deep dive. If you're joining us right now, you are probably trying to make sense of the absolute whirlwind that is the crypto market this season.
Oh man, it's been a complete chaos lately.
Complete chaos. But we've got a towering stack of research notes, market analyses, and raw on-chain data sitting right in front of us. Our focus today is specifically on the spring 2026 Layer 2 landscape. And let me tell you, sifting through these reports, it is incredibly clear that we are looking at a completely shifted paradigm from what we experienced even just a year ago.
Yeah, the market is playing by an entirely new set of rules right now.
Exactly. We've taken all these diverse sources, filtered out the noise, and refined the information down to the essentials you need to navigate this space. Okay, let's unpack this. Our mission today is twofold. First, we're going to decode exactly why the current market cycle is behaving so differently from the past. And second, we're going to examine three highly specific, high-growth protocols that our research stack indicates are structurally positioned for a breakout.
That's a great summary of what we're tackling today. And to really grasp why these three specific protocols stand out in the data, we have to first understand the broader macroeconomic environment setting the stage. Right now, the entire ecosystem is digesting what the research reports are calling the Ethereum Pectra upgrade leftovers.
Right. The Pectra upgrade was a massive milestone. But for those who aren't reading Ethereum developer forums every single night, what exactly do these reports mean by leftovers? Like, how did Pectra actually change the playing field?
Right. So for context, the Pectra upgrade essentially introduced a new way to bundle and process data. It made it drastically cheaper for Layer 2 networks to post their transaction receipts back to the main Ethereum chain.
Okay.
So the leftovers we're talking about are the ripple effects of that newly cheap block space. What's fascinating here is how this reduction in operational costs has acted as a profound structural shift.
Like a catalyst.
Exactly. It's forcibly migrating liquidity away from older network models and funneling it directly towards specific high-throughput scaling solutions. We are seeing a distinct, measurable migration of capital in the on-chain data.
And the notes keep highlighting this one specific metric regarding that capital migration. It's the gap between total value locked, or TVL, and the actual token prices. Why is that specific divergence flashing green for our researchers?
Because it represents a fundamental tension in the market. Total value locked is the amount of actual hard capital that users have deposited into a network's smart contracts. It shows real utilization.
People actually using the chain.
Exactly. The research points out that right now we're seeing billions of dollars flowing into these newer networks. They're generating fees, they're driving activity. However, the market caps, the prices of the tokens themselves, haven't appreciated to reflect that heavy usage yet.
Which creates that economic tension.
Right. The network is highly valuable based on its usage, but the token price is lagging. And according to the historical data in our sources, when we've seen this specific overlap of high network use and low token valuation in the past, it's often preceded major market repricing.
It's like a coiled spring waiting to release. So what does this all mean for the older technologies? You know, the networks that completely dominated the headlines during the last market cycle.
The consensus across our source documents is quite sobering for those older networks, honestly. General-purpose rollups are rapidly losing their market dominance.
They're just bleeding out.
They really are. The one-size-fits-all approach to building a Layer 2 blockchain is losing market share to highly specialized, application-specific chains. Think about it like a massive department store versus a specialized boutique.
That makes sense.
In the early days of scaling Ethereum, it made logical sense to build broad networks that tried to accommodate everything at once. Gaming, decentralized finance, social media, all sharing the exact same digital real estate. But as the tech has matured, those broad networks are just becoming congested and inefficient.
Because an application that requires heavy, complex computational power naturally needs a vastly different underlying architecture than an application that prioritizes, say, absolute transaction privacy.
Precisely. The market is waking up to the fact that specialization is just way more efficient than generalization. And that brings us directly to the first major protocol highlighted in our stack.
Yes, let's look at protocol number 1. The notes refer to this as the privacy powerhouse. What stands out immediately in the market analysis is that this project is still largely ignored by retail investors.
Completely ignored.
Right. It is flying under the radar on mainstream social media, but the institutional data tells a completely different, much more active story. The technology here relies heavily on zero-knowledge proofs, or ZK proofs. For those of us who hear that acronym constantly but might not fully grasp the mechanics, how does this actually work in practice?
The easiest way to understand a zero-knowledge proof is to imagine a bouncer at a club.
Okay.
You need to prove you are over 21 to get in. Normally, you hand over your ID, and the bouncer sees your full name, your exact birth date, your home address. A zero-knowledge proof is a cryptographic method that allows you to prove to the bouncer that you are over 21 without revealing any of that other sensitive information.
So the bouncer just knows you're good to go.
Exactly. They mathematically verify the claim is true without ever seeing the underlying data.
Okay, that makes perfect sense.
Yeah.
So how is this protocol applying that bouncer concept to the blockchain?
They are applying it to solve a very specific trillion-dollar problem for 2026, providing compliant institutional privacy.
Compliant being the key word there.
Yes. Institutions like traditional banks, hedge funds, and large asset managers are eager to operate on decentralized rails because the settlement speeds and yields are highly attractive. But think about their operational reality. A major hedge fund cannot have its entire trading history, wallet balances, and strategic market moves broadcasted on a public ledger for every competitor in the world to analyze and front-run.
Right. Wall Street doesn't publish its proprietary trading algorithms on the front page of the newspaper, so they certainly aren't going to execute trades on a completely transparent blockchain where everyone can see their hands.
Exactly.
But on the flip side of that, they also can't just use tools that mix and hide money in the shadows because regulators would come down on them instantly. So how does this protocol solve that compliance piece?
That is the exact needle this protocol is threading. It allows for absolute privacy of the transaction details using those ZK proofs, but it builds in programmable compliance tools. An institution can cryptographically prove to an auditor or a regulatory body that they are not dealing with sanctioned entities and that their funds are legitimate, all without ever revealing their actual trade data to the broader public.
Wow.
It is privacy with a cryptographic backdoor for compliance. The reports indicate this is the exact infrastructure institutional capital has been waiting for.
It's building the necessary plumbing for real adoption. And the sources point to a very specific near-term event that makes this highly relevant for you listening right now. In April, this protocol is launching a native incentive program. The reports describe this as a strategy to vampire attack liquidity. What does that actually mean in this context?
A vampire attack is a strategy where a new protocol offers significantly better financial incentives, like higher yields or token rewards, to intentionally drain users and capital away from an established competitor.
Oh, I see.
Imagine a rival bank opening across the street offering 5% interest on savings, while your current bank only offers 1%. Capital naturally flows to the better yield. The research expects this April program to strategically siphon liquidity away from those older, general-purpose networks we discussed earlier.
And when we look at the on-chain metrics leading up to this April event, the setup is really interesting. The analysts point out a clash. There is a historically low circulating supply of this token available on the open market, and it is colliding with a sudden vertical surge in daily active addresses.
It's a classic supply and demand tension. Skyrocketing active addresses indicate real network adoption and wallet creation. But the available supply of tokens you can actually purchase is incredibly thin.
So squeeze is coming.
According to the data models in our sources, yes. When high demand hits a low supply wall, especially with an incentive program about to accelerate that demand, it creates conditions historically associated with significant price discovery. The market eventually has to resolve that fundamental mismatch.
So if ZK proofs are solving the privacy problem for Wall Street, what happens when all these different specialized networks need to actually talk to each other? Moving on in our notes, the research highlights a glaring fragmentation problem across the industry, and I can personally vouch for this. I remember trying to buy a simple digital collectible last year.
Oh no, I know where this is going.
By the time I bridged my Ethereum to a specific layer 2, paid 3 different transaction fees, and waited 30 minutes sweating over whether I typed the right hexadecimal address, the sale was completely over. It is a user experience nightmare.
It absolutely is. And if we connect this to the bigger picture, fragmentation is the natural, unfortunate byproduct of moving away from one single Ethereum chain to dozens of specialized layer 2s.
Right.
The second protocol in our research stack, which the analysts have dubbed the Modular King, tackles this by fundamentally redefining interoperability. It doesn't just build a slightly faster bridge. It utilizes a shared sequencing layer and modular data availability to essentially make the concept of bridging obsolete.
Okay, let's break that down for the listener. Modular data availability and shared sequencing, Those sound incredibly dense. How does this actually work?
Let's use an analogy. Instead of one single computer trying to do all the complex math, store all the heavy files, and check all the security rules at the same time, a modular system breaks these jobs apart like Lego blocks.
Makes sense.
Data availability is just the specific Lego block that ensures the receipts for every transaction are safely stored and visible to anyone who needs to check the math later.
And the shared sequencing.
A shared sequencing layer acts like a single, highly efficient traffic cop managing an intersection, rather than having 5 different uncoordinated stoplights. Because this protocol handles the ordering of transactions for multiple networks simultaneously, it allows for what we call atomic asset transfers.
Meaning the transfer happens instantly across networks all at once, or it doesn't happen at all. Your money doesn't get stuck in limbo. But let me stop you there and push back a bit. That sounds great in theory, but traditional bridges were hacked for billions of dollars over the last few years. Is this shared sequencing layer actually more secure, or are we just moving the vulnerability to a new, untested piece of technology?
That is the critical question. The vulnerability in traditional bridges was that they acted as massive honeypots. You had to lock up your tokens in a smart contract on chain A to get a synthetic version of those tokens on chain B. Hackers targeted those locked up pools of funds.
Honeypots.
Exactly. Atomic transfers eliminate the need for those vulnerable honeypots entirely. By removing that specific friction and that central point of failure, this protocol is laying the groundwork for a unified, much more secure user experience.
And what sector are they choosing to unify first? The notes highlight some highly relevant, time-sensitive data here. They are aggressively targeting the industry that demands the most frictionless experience possible, which is gaming. Huge sector. Massive. This modular king hasn't just been building abstract tech. They've been quietly signing partnerships with traditional AAA gaming studios. And the catalyst here is imminent. They are actually launching exclusive titles on this specific Layer 2 later this month in March 2026. We aren't talking about clunky browser games. We are talking about high-fidelity games where the blockchain elements are completely invisible to the player.
And that invisible integration is widely considered the ultimate goal for Web3 gaming. When a player can purchase an in-game item without ever needing to know they are signing a cryptographic transaction or bridging an asset, that is the exact moment you unlock true mainstream adoption.
And the market sees that.
The market analysis in our sources indicates the financial upside here is compelling. If you look at this protocol's current market capitalization and compare it to the heavily saturated top 10 crypto assets, the gap is substantial.
Right. The reports note that the top 10 assets would require hundreds of billions of dollars in new capital just to double their current price. Meanwhile, this protocol is sitting in a sweet spot. It is proven technology, real-world catalysts arriving in March, and a valuation that has not yet priced in this fundamental network growth. It represents a clear value observation within the high-growth sector.
It is a strong structural play, but if we were looking for explosive, frontier-level technological growth, we have to examine the intersection of the two most dominant narratives of this decade.
Here's where it gets really interesting. Protocol number 3, the AI native execution layer. We all know artificial intelligence is reshaping the global economy, but the bottleneck for AI development right now is access to compute power and the danger of centralized corporate control. This third protocol is specifically engineered to bridge blockchain and AI.
And the research makes it clear this isn't just a marketing gimmick where they slap the letters AI on their website.
Right, we've seen plenty of those.
Too many. No, this is a deep infrastructural integration. The sources detail how this protocol mandates specialized hardware acceleration at the node level.
Which means what exactly?
To understand why this is a breakthrough, think of a traditional blockchain node, like a highly secure calculator. It's incredibly good at basic math, checking account balances, and verifying digital signatures. But artificial intelligence requires processing millions of possibilities simultaneously. It operates much more like a high-end graphics card rendering a complex video game.
Okay, I follow you.
This AI native protocol essentially requires its validators to bring those heavy-duty, specialized graphics cards to the network. It restructures the physical requirements to efficiently handle complex machine learning workloads.
So if you are a developer building an autonomous AI agent, for example, an AI that automatically negotiates freelance contracts for you, or an AI that actively trades markets based on sentiment, you don't want that agent relying on a centralized corporate server like AWS, where a single company could just pull the plug on your program.
Exactly. You want it decentralized.
You want it living on an unstoppable, decentralized network. But it needs a network powerful enough to actually think.
It provides that exact specialized hardware environment. And just like the first two protocols we unpacked, there is a significant economic catalyst approaching here too. The notes highlight a structural supply shock scheduled for late spring in the form of a major token burn mechanism.
A token burn is essentially when a protocol permanently removes a portion of its own cryptocurrency from circulation, right?
Correct. It is functionally similar to a Bitcoin halving, which reduces the issuance of new coins. This specific mechanism will permanently destroy a significant percentage of the transaction fees generated by the network, rapidly tightening the available token supply.
So less tokens available over time.
Yes, and when you combine an artificially restricted supply with a network that is positioning itself as the foundational compute layer for decentralized AI, the economic implications outlined in the research are quite profound.
And it isn't just theoretical economics. The most surprising stealth metric I found in this entire stack of research involves the developer data. According to the on-chain analytics, developer activity on this specific AI chain has quietly tripled since January. Tripled in just a few short months.
That developer growth is heavily emphasized in the reports as the ultimate leading indicator. Complex applications take time to build, test, and deploy. Historically, asset price eventually follows the utility created by those applications.
But the price hasn't moved yet.
Right now, the analysts note a massive divergence. Despite this tripling of developer activity and the looming supply shock in late spring, the price of this asset remains trapped in a very tight accumulation zone. The broader market clearly hasn't noticed the silent builder phase happening beneath the surface.
What is an opportunity?
It really is. This divergence signals deeply untapped potential for anyone paying attention to the raw data before the narrative hits mainstream news outlets.
Okay, so we've covered a tremendous amount of ground today. We've explored the institutional privacy powerhouse, the interoperable modular king tackling gaming, and the AI-native compute layer. The underlying tech is fascinating, and the catalysts are right around the corner. But let's bring this back to you, the listener.
The practical application.
Exactly. How do you actually apply this knowledge? If you are looking at your own research or your portfolio right now, how does the source material suggest strategizing for this spring 2026 landscape?
The source material provides a very clear strategic allocation framework based on balancing risk tolerance with the broader 2026 technological roadmap. It uses a weighted exposure model, often referred to as a barbell strategy.
How does that break down?
For a balanced approach, the framework suggests anchoring the speculative portion of a portfolio with the modular king. Its interoperability thesis and immediate gaming partnerships offer the most easily understandable consumer adoption curve.
It's the safest bet of the three, relatively speaking.
Right. From there, you weight the privacy protocol based on your conviction in institutional capital flows. This is a slightly longer-term thesis, but it offers immense structural upside if traditional finance embraces these compliant rails.
And the AI protocol.
Finally, the AI native layer is treated as the highest growth, highest volatility play. Because it is frontier technology, the risk is naturally elevated, but the reward profile during a supply shock is heavily asymmetric.
It's a targeted strategy, highly focused on this new era of specialization. But timing in these markets is everything, right? You can have the most thoroughly researched thesis in the world, but if your entry and exit points are completely off, the underlying technology doesn't matter. When we look at timing the market, our notes point to a very specific operational window.
Yes. The market analyses strongly suggest that we will hit a peak liquidity phase in May. As the Ethereum Pectra leftovers are fully digested by the ecosystem and these specific protocol catalysts, the April privacy incentives, the March gaming launches, and the late spring token burns all converge, the reports expect a crescendo of market volume.
A perfect storm.
Essentially. The key technical indicators the analysts are watching involve relative strength indices diverging from the TVL growth we mentioned at the top of the show. The sources explicitly identify target sell zones during this anticipated May liquidity peak. The strategy outlined isn't to hold these assets blindly forever.
No diamond hands here.
Right. It is to ride the fundamental wave created by these catalysts and take profits into the heavy retail liquidity that historically arrives late to the party.
You want to be calmly scaling out of your positions when everyone else is frantically rushing in because they just saw a headline about it on social media. And to help you actually execute this strategy without having to stare at complex charts 24 hours a day, our research notes heavily reference an incredibly useful community tool.
That spreadsheet is vital.
It really is. There is a specific, actively managed community spreadsheet designed precisely for tracking these three protocols. It dynamically pulls in the on-chain metrics via APIs, tracks the TVL divergences we discussed, and maps them directly against those targeted entry points and may sell zones in real time.
It takes the emotion out of it.
Completely. It is an incredibly actionable resource to take all this macro theory we've discussed and turn it into a concrete, observable game plan. Make sure you track that down to keep your finger on the pulse of the data.
Having a strictly data-driven system to track these specific indicators is precisely what separates reactive market participants from strategic ones in an environment moving this quickly.
I couldn't agree more.
Yeah.
Okay, let's take a breath and recap the journey we just went on. We started by unpacking the significant macro shift happening in the ecosystem right now. The decline of the broad, general-purpose rollup and the substantial liquidity rotation into hyper-specialized chains, all driven by the newly cheap block space from the Pectra upgrade.
That structural shift is the foundation.
Yep. Then we looked at the privacy powerhouse, utilizing zero-knowledge tech to build compliant institutional rails, complete with a liquidity drain event expected in April. We examined the modular king, solving the dreaded bridging nightmare and launching invisible Web3 gaming titles later this month. And finally, we explored the AI-native execution layer, featuring custom hardware requirements, a tripling of developer activity, and a structural supply shock coming in late spring.
This raises an important question, though.
What's that?
It's a final implication from the research that we haven't explicitly discussed yet. If the dominant, undeniable trend of 2026 is moving away from general-purpose networks toward highly specialized, fragmented chains like we saw with privacy, gaming, and AI, what happens when all these hyper-specialized chains inevitably need to talk to each other to function as a global economy?
That's a good point.
Think about the logical conclusion of this trend. Will the future of blockchain essentially become an invisible, highly fractured back-end of microservices where the end user doesn't even know or care which specific layer 2 they are actually interacting with at any given moment?
Oh, that's a wild thought to leave off on. The ultimate success of decentralized tech might just be its total invisibility to the everyday user. We will leave you to mull that one over. Thank you so much for joining us on this deep dive.
The landscape is moving faster than ever, but by following the data and understanding the foundational shifts, you are already steps ahead of the crowd. Keep exploring, stay curious, and keep diving into the fascinating, ever-evolving world of decentralized tech.